Well, let's say it's a disease that you can actually test and draw blood and test for, so it's not subjective. What's the big deal with medical tests in this country and in the US and pretty much everywhere else? Yes? I'm sorry?
Ethics? Like,
of those subjects, right?
Yeah.
What is exactly wrong with the subjects in those studies most of the time?
Cancer.
Maybe physical condition of the person?
Caused by what? They're often involved in multiple studies and multiple drugs at the same time, right? Because that's how those people are make money. Especially if you don't have to be sick to test a particular drug. That actually has been, I'm actually surprised that you guys haven't heard about this. A couple of years ago, there have been articles about this all over the place. That people who participate in medical studies usually participate in several, because that's how they make money. And there could be multiple drug interaction effects during those trials, and how do you figure it out? They don't tell you that they're in 15 other trials too, right? So, because then they be excluded from yours. So that's a big deal with medical tests. But I don't know what we're talking about. Now, so is everything bad? This has sort of been a gloomy conversation, right? I mean, theory sometimes makes wrong assumptions, empirics we can't really trust because sometimes data plays tricks on us and stuff like that. Is it all bad? No. Finance has produced quite a few successful models. One of them is Black-Scholes. You have, or will be, studying in your options pricing classes. Black-Scholes is considered to be a very successful model that actually works most of the time, right? And that model is derived from, what's the history of Black-Scholes' option pricing model? We actually borrowed most of it from physics, right? From diffusion physics. Physics of diffusion or whatever. Yeah, that's the basis of it, right? And then Ito calculus. Did they teach you guys Ito calculus? I've been wondering for all this time. Okay, so that's that there too. There are some not so good ones, and you guys should be closely familiar because the guy went to your school. Unless some of you are from Norway only. David Lee created a model, and that has been successfully used over a number of years. That's called Lee's copula, right, to price certain instruments. But the assumptions that that model made were not the best assumptions, and eventually it broke down so bad that a lot of financial institutions broke down with it. And what's that big assumption that this model makes that it shouldn't have made, but it did? What's it? That you can easily figure out correlations between two assets, and that's the correlation that you should be looking at, right? Because copula depends on the function depends on the correlation coefficient between two assets. So you have to assume that the two assets, as they've been correlating in the past, will be correlating in the future, right? And sometimes that doesn't happen, especially when you have a financial crisis on your hands. So sometimes the models that we create are not very successful. Sometimes theory actually blends with empirics and creates quite successful results from that. And that's the CAP-M. Some of you have heard of it, some of you will. And the three-factor model. Now, I probably don't have time to talk about this anymore. So let me just show you very, very quickly how CAP-M was derived. It was derived like this. And this is it, right? Basically, it's actually a pretty simple derivation. You look at a return on a portfolio that consists of another portfolio, a market portfolio, and one extra stock out. You look at its expected return and the standard deviation of that thing. And then you try to figure out how the expected return and the standard deviation, the variance of this portfolio are going to change if you change the weight of that one stock I in it. And that's where this big nasty formula over here comes in. But you do a mind trick and you figure out that actually the only time you would have stock I kind of by itself in this portfolio is when stock I is in extra demand. And extra demand is not possible if the market is in equilibrium. So technically the weight of stock I in your portfolio of all stocks should be 0. So then you evaluate those partial derivatives as A equals to 0, and they turn into something very simple that could be put into this CAP-M formula that, once again, most of you have seen, and those of you who haven't will see it in your, I'm not sure what class, I guess Will's class. So now, CAP-M was this really nice theoretically derived formula that worked once in a while, but not all the time. There were definitely exceptions to when it worked, And one of them was, for example, that it couldn't explain the fact that small stocks usually earn higher returns than large stocks, and that stocks with low market-to-book ratios usually earn higher returns than stocks with high market-to-book ratios. So what people did is they tried to wrestle with that, try to figure out if they're counting numbers correctly. They figured, well, most of the time they do that. Then they tried to think theoretically about why small stocks usually outperform, and this model can't handle this stuff. Eventually, these two guys, very famous names in finance, kind of said, well, look, while we're trying to figure out theoretically why this is happening, why don't we just add those two factors into the CAPM model, turn it into a three-factor model that will have the beta in it, and then we'll have the returns, the differences in returns of small and large and high and low market to book, and that's how we use it. So they created a three-factor model, and it turns out actually that when you do this, the model itself works much better, can explain up to 97% of variation in returns in certain stock portfolios. So this is definitely a good thing for us, right? Because the more returns we can explain, the better for us. Then there was a guy, I don't have it on the slide, but then there was a guy who in the year after, 1997, said, oh, and if you add the fourth factor to this, then we're even better. So now we actually have four-factor models, and that's what most hedge funds and most quantitative, and even not so quantitative investment firms use. So this is definitely a success of finance as a science that blends theory. The theory of CAPM actually comes from the early 50s, right? Well, sorry, from the early 60s. With empirics that came much later, and we're blending this stuff, and we're actually figuring out some cool things. Now, this is almost the end. The question is, where do we go from here? I told you that economics and finance kind of said that crises, such as the one we just lived through, were definitely possible. Models created by economists and financial economists have described exactly how these crises were going to roll. For some reason, no one listened to us, and we sort of tried to figure out why no one listens. And we said, politics. Because, you know, I don't know if you guys watch those political channels, such as C-SPAN in the US, and I'm not sure which one in Canada does this stuff, because I've just given up on watching it. But you sometimes listen to what these politicians have to say, and you figure out, you definitely did not take any econ in your university or did you go to it? So sometimes it's very difficult to convince people that something that is quite complicated actually has to be done in a quite complicated way to make it work. People usually, especially people in politics, usually care about other things, such as winning the next election. So there's definitely a disconnect between the science of finance and the science of econ and the decision makers. So this is probably where we should work, what we should work on. And we should also work on explaining things better. There is a very vastly developing area of behavioral finance and behavioral economics where economists look at how we can explain those irrational things that people do and how we can blend this new knowledge into our existing understanding of how the economy works. And those studies have been quite successful. There is Andriy, a very famous financial economist from MIT. He's currently working on something that he's not showing to anyone yet, but he's saying this is going to turn things around, and he calls it adaptive markets hypothesis. So instead of efficient market hypothesis, he proposes markets are efficient sometimes, but then they're mostly adaptive. They adapt to things. Kind of like what we talked about when we talked about flu viruses, right? So he thinks that will sort of change the way we view things in these sciences, economics and finance. So we're definitely doing, and by we I mean people who do this research in finance, we're doing quite a few cool things. And this is where I hope that some of you at least will come in. I honestly encourage you to consider a career in academics. I told you about the salaries. The salaries are not too bad, and by the time you guys graduate, they'll probably go up to 150 starting. They have been going up about 5,000 a year in the past couple of years, so, well, in the past few years actually. So compensation is there. The questions that academic finance and academic econ ask are very interesting questions. I mean, how do we get out of the next crisis? How do we price assets that no one understands what actually, or how they work? Or how do we price things that we actually do understand? I mean, you just looked at it, you just saw CAPM. CAPM sometimes breaks down and prices something that we know a lot about, stocks.